In 2026, the global business world witnessed a financial anomaly that completely defied everything taught at the world's elite business schools. A new wave of hyper-funded corporate startups was scaling at a breakneck, terrifying speed. Corporate boardrooms were filled with optimism, tracking user acquisition data and projection charts that promised absolute market dominance. The air was thick with the scent of unearned victory. Millions of users downloaded flashy new applications, enticed by clean user interfaces and push notifications promising instant fulfillment. It felt like the future had finally arrived. On the ground, an army of low-wage delivery riders braved treacherous monsoon rains and chaotic city gridlock. They rushed to transport basic items across grid-mapped metropolises. But beneath the surface of this operational marvel sat a dark, terrifying, and completely unsustainable reality. The financial foundations were built on quicksand. One prominent quick commerce platform managed to generate thousands of crores in top-line revenue, yet simultaneously recorded a catastrophic loss of over 5,000 crore rupees in a single fiscal year. They were burning millions of dollars of investor cash every single day just to deliver a carton of milk. Yet, right outside their headquarters sat a completely different financial reality. Nestled smoothly at the base of the asphalt was a traditional, warmly lit neighborhood convenience corner shop run by a 55-year-old local merchant. He didn't possess an engineering degree. He didn't use predictive algorithms. He didn't even own a website. Yet, he was calmly counting a thick stack of real cash. His shelves were packed tight with physical inventory that actually moved. He had zero debt, zero outside investors, and a net profit margin that remained permanently positive. While the multi-billion-dollar tech startup was actively bleeding to death in a desperate bid to buy market share, this street merchant was building quiet, generational wealth. Why do elite corporate executives with Ivy League master's degrees consistently lose money where an uneducated street hustler turns a massive profit? Welcome to the brutal reality of the Street MBA. To understand this fundamental breakdown, we must first look at the grand illusion of the modern corporate world: gross merchandise value, commonly known as GMV. CEOs are continuously incentivized by their venture capital boards to prioritize explosive, artificial growth over actual, sustainable bottom-line profitability. They track graphs that point sharply to the sky, celebrating transaction volumes while entirely ignoring the massive cost required to buy those transactions. They build a house of cards. They lease massive networks of micro-fulfillment hubs, known as dark stores, inside high-rent urban corridors. These properties demand exorbitant security deposits and fixed monthly overheads before a single order is even placed. Inside these dark stores, thousands of distinct items sit idly on industrial racks. Millions of rupees in working capital are frozen in low-velocity inventory that rots before it can ever be sold. Complex automated conveyor systems and proprietary routing software are deployed, requiring armies of software engineers and continuous maintenance fees to stay online. To attract users, the corporate startup heavily subsidizes everyday goods. They offer artificial 50% discounts and free delivery codes, meaning they lose money on every single package. They are trapped in a vicious cycle where growing bigger simply means losing money faster. The capital burn rate accelerates every single month. They present beautiful, elaborate slide decks to institutional investors, raising fresh rounds of venture capital just to keep the lights on for another quarter. They celebrate the act of raising money as if it were a profit milestone, confusing investor charity with commercial validation. But on the street, vanity metrics hold absolutely zero value. Cash is the only truth. Let us reverse engineer the street merchant's operational model using formal business frameworks. The street vendor operates on an airtight foundation of perfect unit economics. His fixed overhead costs are effectively zero. He often owns his micro-footprint space or operates out of a minimal rent inherited location, eliminating real estate risk. He completely masterfully controls his inventory turnover ratio. Because his storage space is highly restricted, he cannot afford to hoard products that do not move within 48 hours. He analyzes historical, hyperlocal consumer demand patterns completely in his head. He curates his shelves dynamically to match the immediate, daily nutritional needs of his exact neighborhood. If a particular item drops in velocity, it is instantly replaced by high-demand essentials like bread, milk, or fresh eggs. His working capital is never trapped. Most importantly, his customer acquisition cost, or CAC, is exactly 0 rupees. He does not pay for digital advertisements, search engine optimization, or programmatic media buying campaigns. His marketing strategy is built entirely on the foundational rock of human relationship and proximity. He knows his customers by name, understands their household budgets, and builds intense psychological loyalty. This creates an unparalleled customer lifetime value, or LTV. His core audience will never abandon him for a competitor over a temporary digital coupon code. He operates a pure cash flow business. He buys his supplies from wholesale markets using short-term credit, sells to consumers instantly for cash, and closes his capital loop daily. He does not rely on future monetization theories or speculative market valuations. He measures his business success by a simple, unbendable rule. Is there more cash in the drawer at night than there was in the morning? The fatal error modern corporate executives commit is turning structurally simple operational tasks into massive, unwieldy financial liabilities. In quick commerce, a company must achieve a flawless convergence of order density, high basket size, and perfect weather conditions just to break even on a delivery. The moment a localized flood occurs or fuel prices spike by 5%, their razor-thin margins vanish completely into thin air. Every delayed shipment, every mixed-up package, and every customer return adds immense operational friction that drains cash directly from the company's central bank account. The corporate entity is structurally brittle because it is weighted down by layers of middle management, high payroll liabilities, and intense administrative bureaucracy. A corporate CEO needs to review data analytics, hold committee meetings, and seek board approval just to change the market price of an item. The street merchant, by stark contrast, possesses absolute structural agility. If wholesale prices rise at the morning market, he adjusts his prices on a hand-drawn chalkboard by midday. He acts instantly based on raw, real-time market feedback. He does not answer to a board of directors. He answers directly to the laws of supply and demand. He keeps his operational profile incredibly lean, ensuring his survival. When the economic tide inevitably turns and cheap venture capital dries up, the heavily funded corporate skyscrapers begin to shake violently. The digital illusion shatters. Startups that were valued at billions of dollars disappear into bankruptcy courts. leaving behind empty dark stores and worthless software code. Their unbacked growth model collapses completely. But on the corner of the street, the traditional Kirana shop remains perfectly solid, brightly lit, and highly operational. It has outlasted another heavily subsidized corporate wave. The brutal lesson of the Street MBA is clear. Top-line expansion without underlying unit profitability is not an achievement. It is simply a slow-motion countdown to financial ruin. True commercial mastery does not require a fancy credential from an elite institution or access to global sovereign wealth funds. It requires mastering simple math. It requires staying agile, controlling your overheads, honoring your customer relationships, and choosing cash survival over corporate vanity metrics. The deepest business truths are practiced every single day right on the street.